You take the same setup on 2 different days. Monday, clean breakout, volume behind it. By Tuesday afternoon, you're stopped out. Wednesday, an identical pattern on a different name, this one runs 3% in an hour. Same chart pattern, very different outcomes, and the difference usually isn't in the setup. It's in the environment the setup is trading inside. Every chart lives inside a broader picture. Which sectors are leading, which are lagging, whether the market as a whole is friendly to risk or pulling back from it. This video is about that bigger picture. Sector rotation, the pattern of which industries lead when, and market regime, the state of the tape that decides whether today is a day setups tend to work or a day they don't. Here's a mistake most new traders make. They find a clean setup on a stock, clean chart, great level volume, they take the trade. But they're only answering one question. Is the stock setting up to move? They skip the second question. Is the stock sector setting up to move? Because the best stock in the worst sector still fights uphill. When the whole group it belongs to is under pressure, your individual name, no matter how clean the chart looks, is swimming against the current. The reverse is also true. A mediocre setup in a strong sector often outperforms a clean setup in a weak one. The group tide matters more than most traders realize. So the first question a setup should face isn't just is the chart clean, it's is the sector in favor. Which means the first thing a trader needs is a way to see which sectors are in favor and which aren't. Sectors don't all move together, they rotate. Money flows from one group to another in a rough pattern that tends to repeat across market cycles. There's a classic 4-phase cycle, early bull, early bear, late bear, and each phase has a different sector profile. In early bull phases, when fear is still fresh, defensive sectors lead. Consumer staples, utilities, healthcare, names that generate cash regardless of what the economy does. As the recovery matures, leadership shifts. Technology and consumer discretionary start outperforming. Growth takes over from safety. When conditions start turning, the market preemptively moves back toward defensives and into commodity-linked sectors, energy, materials. And in late bear phases, when things are outright ugly, utilities and staples usually bottom last, because they held up best all the way down. The cycle isn't rigid. Every real market has exceptions, dislocations, surprises. But the broad pattern, leadership rotating by phase, is as old as the stock market itself. Zoom out from the cycle phases. Here's the simpler read. In a bullish tape, markets rising, risk appetite up, you'll see technology, consumer discretionary, and financials leading the indices. In a bearish tape, markets falling, risk appetite compressed, you'll see consumer staples, utilities, and healthcare leading. Not because they're going up a lot, because they're going down less. Which is the tell. When defensives are at the top of the leaderboard, the market is in a risk-off mood, even if the indices haven't cratered yet. And that's the bridge back to your chart. The same bullish setup inside risk-on leadership has a very different expected behavior than inside risk-off leadership. This isn't a rule you trade directly. It's context you read before deciding whether the setup in front of you has wind at its back or wind against it. Pull even further back. If sector rotation is where the money is flowing, regime is the overall temperature. At the highest level, the market sits in one of 3 regimes. Bullish, risk appetite up, leadership broad, trends extending. Bearish, risk appetite down, leadership narrow and defensive, trends breaking. Or neutral, no strong bias either way, the tape is choppy and inconclusive. Regime is a state, not a forecast. It describes where the tape is right now, not where it will go next. No one can forecast the regime, but anyone can read what it currently is. You read it from the public data, which sectors are leading, whether breadth is positive or negative, whether volatility is contained or expanding, whether macro news is creating uncertainty. The setup you're looking at behaves differently in each regime. Bullish regime plus clean setup equals tailwind. Bearish regime plus clean setup equals headwind. Neutral regime means the setup is on its own, no external push, no external drag. Regime isn't a gate. A clean setup can still work in a bearish tape. But knowing the regime tells you whether the trade is swimming with the current against it or in still water. Inside ArcAlpha, the markets page is where this bigger picture lives. It's designed as the morning pre-flight check, a single screen that aggregates the public indicators that tell you what kind of day this is. Open the Sectors tab. You see the sector momentum table, 1 row per sector ranked by performance. On each row is a flow column. That column labels how capital is rotating through that sector right now: strong up, flat, lean down, or strong down. Not a call, a per sector scoreboard. Next to the flow column is a regime column. Each sector labeled bullish, bearish, or neutral, the same read we just talked about for the whole market, now applied one group at a time. the forest and the trees on a single screen. What the platform does, aggregate, display, keep the reading current. Every user sees the same aggregation. Every user sees the same label. What you do, read the aggregation. Decide whether the current regime is friendly to the setup you're considering. Apply your own judgment about whether that matters more today or less. The platform surfaces the backdrop. You decide how to trade inside it. So here's the stack. A trade is never just a chart. It's a chart inside a sector inside a regime. 3 reads in order. The regime is the market friendly or hostile to risk right now. The sector is the group this stock belongs to in favor, out of favor, or neutral. The setup is the pattern on the individual chart clean. The regime and sector reads don't replace your chart work. They tell you whether the chart work has wind at its back, wind against it, or no wind at all. Traders who read all 3 tend to size differently on aligned trades versus misaligned ones. They tend to skip trades where all 3 are pointing the wrong way. They don't stop trusting the chart, they just give the chart less weight when the environment is against it. Which brings us to the question, what are the specific indicators you read to figure out the regime? So that's the frame. Chart, sector, regime, 3 layers of the same market. Sector rotation tells you where money is flowing. Regime tells you the overall temperature of the tape. Both are observable from public data, neither is a forecast. The markets page aggregates the aggregation for you. In the next video, we'll look at the specific way ArcAlpha reads the regime, the risk gauge. 6 sub-indicators derived from public ETF flows and cross-asset data, composited into a single 0 to 100 score on the markets page. This is educational content and is not a recommendation to buy or sell any security.